Equity markets have fallen since the middle of August, giving up all their year-to-date gains so that in local currency terms they are now down approximately 1%, although in euro terms are up 4% given the weaker euro. The recent weakness has been caused mainly by concerns over the growth outlook in the Chinese economy and possible contagion to the global economy, although the breaking of chart support levels in markets and forced hedge fund selling around the 20th of August contributed to sharp falls in equities over the following 3 days. While remaining volatile, markets have held around the levels and shown some modest improvement from the lows reached on the 24th of August. Growth in China has slowed from pre-crisis levels of over 10% per annum to around 7% currently based on official data releases. There have been some suspicions over the accuracy of official data in recent years, and in efforts to better estimate underlying growth, investors have instead turned to other, more reliable data points. One such measure is government tax receipts, as shown in the chart. While tax revenues have slowed from the mid-teens growth rates evident 3 years ago, they are still growing almost 10% per annum based on receipts up to the end of July, indicative of solid underlying growth in the economy. Similarly, with regards to electricity consumption, while usage has slowed in recent years due to declines in energy intensity, so that less electricity is required for a given unit of GDP growth, due to improved efficiencies and a switch in the economy away from energy-intensive manufacturing towards services. Current electricity usage, as shown in the chart, is consistent with GDP growth levels of over 6%. Combined with other more reliable indicators such as railway freight shipments, lending data and retail sales figures, underlying growth in the economy is estimated to be running at over 5%. While growth in China has slowed and is possibly running below official estimates, growth still seems relatively strong, and the economy does not appear to be experiencing a hard landing and a slowdown to the extent reflected in recent equity market falls. While growth concerns related to China appear overdone, global central banks have responded to the concerns over the downside risks to inflation from renewed weakness in oil prices and deflationary pressures from weaker emerging market currencies and potentially lower growth in emerging market regions. The ECB has indicated it is ready, willing and able to change the size, composition and duration of its current asset purchase programme, and has indicated risks to its already lowered inflation forecasts are to the downside. As a result, an expansion of the ECB's current asset purchase programme is expected in coming months. In the US, the market's expectations for the timing of the first rate rise have been pushed out to Q1 2016, with Fed members suggesting the case for a September rate rise has become less compelling. The Fed is expected to lower its forecasts for the level of interest rates at the end of 2016 and 17, and should continue to emphasise that when it does eventually begin to raise interest rates, it will only do so very gradually. Similarly, expectations for the first interest rate rise in the UK have been pushed out to Q3 2016, while the Bank of Japan is also expected to announce additional monetary stimulus, given inflation is likely to remain significantly below its 2% target. Overall, global monetary policy is now expected to remain more accommodative for longer than previously expected, which should be supportive of economies and equity markets. Following the recent market falls, equity markets have become more attractive in valuation terms. On a 12-month forward PE basis, global equities are now on 14.5 times, against a long-term average of around 15.5 times. Similarly, on a price-to-book basis, global equities are at 2 times book versus a long-term average of 2.4 times. Against other asset classes such as bonds or cash, equities remain extremely attractive given the relatively low yields available in these alternative asset classes. We believe recent concerns relating to the growth outlook in China are overdone. While growth has slowed and is probably lower than official estimates, on the basis of more reliable data points, growth remains relatively strong at over 5%, and the economy does not appear to be suffering a hard landing. The Chinese authorities have adequate resources to support the economy and are expected to announce additional monetary and fiscal stimulus programs to maintain growth if required. Recent economic releases in developed markets have been resilient, with upward revisions to GDP growth in the US for Q2 to 3.7% annualised, and in the Eurozone to 1.8% for the first half, easing concerns over any possible contagion to the global economy. Global monetary policies could become more accommodative and could be maintained for longer than previously expected, given the increased downside risks to inflation, which would be supportive of economies and markets. Equity valuations have become more attractive following the recent weakness in markets and are supportive of further gains. Overall, we believe markets will recover their recent losses and resume their upward trajectory as confidence regarding the stability and growth outlook for the Chinese and global economies are restored, and additional fiscal and monetary measures are announced. Markets could, however, remain volatile, related to upcoming elections in Greece, Spain and Portugal, news flow on the Chinese and global economies, and debate about rate tightening cycles in the US and UK. But with fundamental and valuation supports remaining in place, the overall trend in equity markets should remain upwards.